neutral to bullish condition. That means you're not buying at an inflated price. So this time period right here, the market is offering an opportunity to be long. I'm not going down to lower time frames today. I'm not going to teach you that today. Only thing I'm giving you right now is developing context around the daily institutional price levels that are arrived at on the daily chart. And all you're looking for is impulsive price swings first, letting price settle back down into equilibrium, and then we discern what we're going to do when we get to that level. As you can see, without going into lower time frames, the price does rally again. Where does it rally back up to? Its old institutional order flow reference point, which is an old high back here. So it goes right above that previous high. See that? Now the market trades off again and goes lower. So we have now a new range. We have to now put the Fibonacci on this high, keeping it off the same low. Now, why did I do that? Because this price low has not been violated. It only retraced down to here. It rallied up again. Then we wait for 3 candles. The high candle to the left, there's a lower one. To the right, there's a lower one. This is probably a Sunday, and even still, this is one here. Either way, you don't want to count Sundays, by the way. MT4 on Forex Ltd does give you the Sunday candle, so you got to factor that out. Don't count Sunday's candle because it's a non-event. So that's probably going to end up becoming this candle here. Once you get the down candle here that the market has in fact turned, it's starting to go lower. Notice what's happening here. We're not rushing. We don't need to catch the high. Okay, it gives us all kinds of time to wait and plan and build an idea about what it is specifically we're going to do when price gets to equilibrium. Price drops down a little bit more, then it goes up. What do we do the whole time this is happening? Nothing. We're not doing anything. This is a higher time frame principle. Most of you are all begging for a higher time frame principle to trade with. This is the beginning building blocks to that. Okay, market trades lower, lower. What do we do here? Nothing. We're not doing anything here yet. Okay, nothing. Trading lower, 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 lower. All of a sudden, boom, it hits equilibrium over here. Now we can start studying price. We want to study price. On the lower time frames, we'll look for entries, but I'm not teaching you entry signals here. I'm giving you context. As soon as we get to equilibrium, we are now at fair market value, so the market is permitted to be bought. Okay, at the banking level, they will be able to buy at these levels because they're not at a premium-based market. The levels that are trading at this level here are at fair market value. Now, banks are just like anyone else. If you go to the grocery store and you see steaks for $10, I don't even know what they cost because my wife does all the shopping. If a steak costs $10 at the market and it drops down to $8.50 a steak, that's probably a discount. And it may not be that price, I don't know, but for the sake of analogy, we're using it. That means that we are now at a discount. Anything below equilibrium is now a discount market. When markets go below equilibrium, they do not spend much time below equilibrium, and there's usually a very dynamic price move away from that, especially if the context behind the marketplace is bullish. Now, looking at this framework we have here, we had an impulsive price swing here, a tiny little retracement, came back to equilibrium, rallied one more time, took out the high over here, and then sold off. Okay, went back down into equilibrium again and went to a discount below 50% of the impulse price swing.